Thank you very much for taking the time to watch this video. The goal of the Money Machine seminar and these videos is to help make you wealthy, and they will. And when I say wealthy, I mean two things. I mean your net worth increasing so that when you retire, you'll retire wealthy. The other reason is I want your cash flow to increase so that when you retire, you can enjoy passive income that exceeds anything you ever earned in your working years. And the Money Machine, if followed, will accomplish both those things. The problem, however, is that anytime cash is flowing in, the government's there with their hands out. They figure if you're making a profit, they should get a part of it. And that's a bit of a challenge. Now, it's a challenge in two places. It's a challenge when you are acquiring the properties and working at paying down the mortgages. And it's also a challenge at the time of your passing when you want to leave your assets to your heirs. And both those things we need to look at. First, let's look at the acquisition and pay down process. The Money Machine seminar is a very simple plan. Buy one property a year for 10 years, never amortize over more than 15 years, and never sell. You follow that? It absolutely works. You'll be wealthy. All right, but let's look at this one property a year for a minute and a very aggressive amortization period on your mortgage. Let's suppose you buy a property for $500,000. Suppose you put 20% down and you put a $400,000 mortgage in place. Now, if that mortgage is amortized over 15 years, during the middle and latter years of the payment process and then 15-year process, you're going to be paying off somewhere in the neighborhood of $30,000 off the principal. But you're not just buying one property, you're buying 10. So from year 10 through to 15, you're going to be paying off principal somewhere around $300,000 a year. That's a lot of money. And the government says, you're earning it. You're not seeing it, but you're earning it. You got to pay tax on it. So what that means is whatever your income level is, you have to add another $300,000 on your income tax return and pay tax on it. And if you're in the top bracket, and you will be if you add another $300,000, that's a little over 50% or $150,000 you have to come up with tax in a year because your mortgages are being paid down. Well, most of us don't have an extra $150,000. So there's some things you have to do. One is there's provision where you can depreciate the properties, and you're allowed to depreciate them at a rate of about 4%. That's not the land, but that's the bricks and mortar, and you can depreciate them by 4%. Now, that doesn't alleviate the tax. It defers it, as we'll see shortly. The other thing is your rents go up every year, and because your rents go up, they go up naturally. You're allowed 2-3%, whatever the government gives. When a tenant leaves, you can move it to market rent. So as time goes on, year by year, the money coming in will increase, and because your mortgages are fixed, you'll have more surplus money to pay the government. The other thing is that after 10 years, you're not acquiring any more property if you follow the simple plan, and the money that you've tightened your belt and been saving can now be used to pay the tax man. And the other thing to keep in mind that at year 16, all the first property is paid for. Now, all the rent from that is surplus money that can go to the government, or it can be used to help acquire another property or shorten other amortizations. So the first few years is the toughest, but bear in mind, you are going to have some serious tax implications, and you need to plan for them. They're going to be there. But let's look at the other one. This is at the time of your passing. Your will states that you're leaving your assets to your heirs. The government takes a look at it and says, when you pass on, at that moment, it's exactly the same as if your properties were sold. It's called a deemed disposition. And there's two tax hits that take place at that time. The first is capital gain. You sell your principal residence, it's exempt from tax at the moment, and so there's no tax. But if you have an investment property, then the profit you make is deemed to be a capital gain. Let's suppose you have a property in your portfolio, and let's say it's worth $700,000. But if you've owned it for a number of years, you may have only paid, say, $200,000 for it. So the capital gain is $500,000. Now, the capital gain level is 50% at the moment, and so you don't pay tax on the whole $500,000, you pay tax on $250,000. But bear in mind, you've got 10 properties, not one. That's $2.5 million that you're going to have to pay, your estate is going to have to pay tax on. But let's suppose each property you depreciated for tax deferral of, say, $50,000. That's not capital gain, that's recapture. It has to be paid back dollar for dollar on your income tax return. So now you're at $300,000 or $3 million in your income tax return for your estate. Add to that probate fees of 1.5% and executor fee, which can be as much as 15%, and you can be up to, say, $4 million that the estate has to pay to the government as tax. Now, if you're fortunate enough to be carrying $4 or $5 million in insurance, that takes care of it. Most of us are not. And in that case, there are other things that you have to take a look at doing. One of the things you may require is to sell off half the properties so that you can pay the government. But that seems like a huge step backwards to, after you personally have worked so hard at following and building up the 10 properties, to get rid of half of them just because of the tax. The other thing you can do is you can refinance all of them and take out enough money to pay the tax. That again is a step backwards, but at least your heirs are starting with 10 properties, not 5. They got a mortgage to pay, but the mortgage isn't as high as the mortgage you had. But they got to take 2 or 3 steps backwards and then start over again. So regardless of what you do, there are going to be tax implications. I want you to be aware of it. I know it's a kind of a negative message, but if you plan for it, if you tighten your belt, if you're aggressive about how you handle it, you can deal with it. And both you during your life and especially in your retirement and your heirs, your kids one day can benefit as well. I want to thank you very much for taking time to watch this video. I look forward to talking to you again next week.